Hey everybody, welcome to Trading Capital's exclusive macroeconomic update. I'm your head market analyst, Curtis Scouten. Jumping into the unemployment chart. In this chart, we're going to be discussing some correlations and why it is important to look at leading indicators as opposed to lagging indicators, which is what our central banks look at. And typically the markets always look forward. They don't have a rear view mirror. They're never looking back. You look back on previous cycles to see what is potentially the likely outcome as we head into the future. But this is the unemployment chart for the United States. And we're going to start off in the year 2000. Why I'm specifically picking the last four major crashes is for one simple fact. In the year 2000, this is where we started introducing quantitative easing and our zero interest rate policy, the ZIRP program. So I wanted to analyze the four previous cycles in which correlate most likely to what the economic policy is currently being run like. So if we look at 2000, this blue line up here represents the unemployment rate. And this is a monthly chart, so it's a very long-term, slow-moving trend. That's what we have to realize. Unemployment is a slow, lagging trend to follow, but it is very important because it does provide many insights. And at the bottom here, this orange line is the S&P 500 or the SPX. So it's been tracking a lot of data over the last 22 years. So I want to start off with analyzing this blue section, the unemployment chart. And what I'm going to explain what this red vertical line is and what this green vertical line is. But the importance of these lines is that in the year 2000, so roughly over here, April 1st, 2000, unemployment pretty much had a low. It made a brand new low. And if you notice the correlation, that's pretty much when your stock market topped. So this is the argument that people keep making, is that, oh, we can't be in a recession, we have low unemployment. It's true. But the point of this chart, as I'm going to show you over the last four cycles, is that when we have low unemployment like we do on this chart over here, it typically defines and signals a top in the markets. And then what happens in a recession or a time of economic decline is unemployment starts to uptick over 12 to 24 months. And then unemployment reaches a peak, which is what it did over here on this green line roughly. And look at the S&P 500, it bottomed. So it's very counterintuitive because you would think that with low unemployment you would have a strong economy. But that is not the case because indexes and indices are always forward looking in the stock market. So it's just very interesting to note that low unemployment rates usually coincide with the top in the market, because low unemployment rate means the Federal Reserve or central banks have achieved one of their two mandates. It's to monitor the employment rate and to keep it as low as possible. So it's really interesting. If we move to 2007, the same phenomenon is true. Basically over here in April of 2007, we hit really a low on unemployment. And look at the S&P 500 index. It started rolling over. Isn't it ironic and very, very crazy that the low unemployment usually signifies a top in the market and it's the time to get out? And then as unemployment upticks, the market conditions get worse until unemployment eventually makes a big run up and peaks, and it puts a near top in a near bottom in the markets. So it's very interesting. Again, that correlation holds true. It was a little bit different here where unemployment still kept increasing because the crisis was very bad. But if you look at when the Federal Reserve started easing and bailing out banks, it was roughly in the early parts of the year here in 2009. So unemployment was still upticking because the housing crisis was so bad in the GFC, but the Fed really started to pivot over here and accommodate banks and started introducing and lowering rates and starting to bail out those parties that needed to. And then let's move forward. So we've looked at the 2000 cycle. Low unemployment signified a top in the markets. High unemployment signified a bottom in the markets. 2007, low unemployment signified the markets rolling over. High unemployment signified a near bottom in the markets. And then if we flip all the way to 2020, we have not had really a crisis, a systemic crisis, which is why we're arguably due. And if we look at 2020, we had extremely low unemployment, and look what ended up happening here. The S&P 500 rolled over. This was your COVID crash, and unemployment briefly spiked as companies were going to have to announce layoffs. The economy came to a grinding halt because of global lockdowns. But that was obviously all pivoted and erased because it was basically countered with excess liquidity being supplied through low monetary and interest rates and fiscal and monetary stimulus. So now it brings us to 2020, and I keep hearing this argument that the labor market is too strong, therefore we cannot be in a recession. But people fail to understand there's a start, there's a middle, and there's an end. I think we're at the start, just like the past previous cycles where we have exceptionally low unemployment. It signifies a top in the markets down by this orange S&P 500 line. So notice how, again, low unemployment, a top in the S&P 500. So over the next 6 to 12 months, and potentially longer if this is any equivalence to the 2008 cycle, unemployment will start to uptick over the coming months. And it's a very slow moving indicator, but once it does start moving into the uptrending zone, that's when the markets will really start to take additional pressure and liquidity hits, as people will eventually, I believe the unemployment rate will hit the real estate market pretty hard. And we'll just have to continue to monitor that, but based off of the last 3 cycles where we have introduced this boom bust central bank policy, it's very probable that we follow the same guidelines and the same cycles as to what the last 3 cycles have experienced. And I think we can just encompass many of the 3 cycles and aspects and what transpired from all of the cycles into what we're going to experience through 2022 and 2023 and potentially 2024. But I don't think this will last into 2024 for the simple fact that central banks will pivot once that unemployment rates. And the scary thing is that when unemployment upticks, it's never a good thing for anybody. But this clearly shows that you have this pretty defined trend line of unemployment that connects these pivots over here from the 50s all the way to the pivots in the 83 over here, 82 area, and to this 2020 high. So conservatively, I think it's fair to assume that we're going to have an unemployment rate at least double to the 6% range. This would be your first level to watch. So that would be basically a straight double from where we are. I think the second intermediate unemployment level, the medium worst case scenario, would be up around this 10% unemployment. And then if something catastrophic happened, we would likely see the pre-COVID highs here around 14. But I'm leaning towards somewhere in the range of this 6.5 to 10% unemployment rate will be pretty much the guide in terms of where central bank policy will start to pivot and pivot drastically by supporting the economy once again. So just keep that in mind. Low unemployment based off of the last 3 cycles, 3 catastrophic cycles, have equaled a top in the markets. And as the unemployment started to rise, the market started to fall even more until you reached a peak in unemployment. That signified a bottom in the markets because that signifies when the central banks will pivot and switch over to focusing their other mandate. And I do believe that we are a long way off from the Fed pivoting because unemployment is still so low at 3.6% here. I know the job loss claims did uptick today on the data, but nevertheless, it is slow moving data. So that's why I think we do have many months ahead of us, at least 2 to 4 quarters before we could potentially see some sort of a pivot. There might be a pause on rates, but they'll still be historically elevated when you compare it and normalize the debt levels compared to previous historical cycles. So just buckle up. The charts are telling me that we are far from over in this bear cycle and that there's a lot more pain to come, especially as that unemployment rate ticks up. Thank you all for being members. Please give this video a big like and comment down below, and we'll stay tuned and keep monitoring all the macroeconomic factors that will put us in a leading position over the